Chris, most recently, the Federal Reserve, the Bank of England, take your pick, central banks around the world using monetary tightening to beat inflation and I guess try to engineer a slowdown. Let's talk about where you think those policy rates are going to end up year end. Maybe let's start with the Fed.
Yeah, so we saw the Fed do their third hike yesterday of 75 basis points in a row. I don't see that slowing down anytime this year. We have another meeting in November and another in December. Not a ton of data ahead of the November meeting, so likely to see another 50, 75 basis points there. Wouldn't be surprised to see the same thing in December. We do start to get a bit more on the retail sales and unemployment inflation numbers heading into the end of the year. So we could see a pause at that point, but I would see the policy rate settling above 4% before the Fed takes their pedal off the gas.
Tell us about market aftermath. What are stocks doing?
Stocks were mixed following the news yesterday and then sold off into the close, anticipating a lower open in Asia. Opened up again weaker here today. I think Jerome Powell reiterating his tone from the Jackson Hole speech that we're likely to see some pain because of the fact that the Fed needs to continue to ease to fight inflation. But the reality is a bit lower, a bit higher of a rate today is better than longer run out inflation long term. That's really going to weigh on the consumer and prices. And so the Fed has to do what it has to do to continue to try to ease inflation, which we did see come back slightly in August to 8.3% off the 9.1% peak in July, but removing energy and food prices, the trend's still moving higher.
Central banks seem to be tightening policy into a recession. What might that look like for economies around the world?
So the Economic Council in the United States didn't declare this a recession, even following 2 quarters of negative GDP growth. That's because of the strength in the labor market. The unemployment rate sits at about 3.7% in the United States. It ticked up 20 basis points last month because of an increase in the participation rate, which is encouraged because we obviously saw that fall off during the pandemic. But the Bank of England has talked about the United Kingdom already being in a recession. I think that we're likely there. You typically don't see a recession called until we're well into it. But it's important to remember that the stock market tends to look 6 to 12 months into the future. It's not the economy and likely going to recover before the economy does. So for people participating in the equity markets, it's something to keep in mind, despite the fact we very well may be moving into a recession.
Let's talk about currencies. I'd like to get into the US dollar. Before we do that, what is a reverse currency war?
So we saw the Bank of Japan actually just intervene in the currency markets earlier today. This is the first time since the Asian crisis about 24 years ago. What they're doing is trying to help support their currency, which is down, I think, almost 20% year to date. We see the DXY, which is the basket of currencies against the dollar, at 111, again, a 20-year high. That's making it extremely challenging for the domestic. It changes the dynamics of the import and exporters in a currency. So if we sit from an exporter in the United States, the price that their consumers are willing to pay is challenged because the price of their good in that local currency goes up. An importer, on the other hand, is paying with US dollars, and so that is a helpful situation to them. And so if you look at economies around the world, you've got to consider whether they're importers or exporters and how that plays for them in currency terms. The other challenge that a lot of international developed markets are facing right now is a lot of commodities, oil included, are priced in US dollars. So that's really challenging areas like Europe and Japan, which are struggling with higher energy prices and trying to keep up with the Fed, and you saw Kerlow today say that they're not interested in rate hiking, but using an alternative method of currency intervention to help protect their currency in what you're talking about in a reverse currency war.
And let's just get into the US dollar, which has been hitting new heights.
US dollars and kind of currency parity 101, basically as short-term interest rates rise, the appeal to buy and then save in that currency goes up. And so that's where we saw a lot of the strength in the US dollar. Fortunately for us as Canadians, the Bank of Canada has been following suit, almost lock and step. We're starting to see other central banks around the world move into this rate hiking regime. We saw England announce a 50 basis points hike today. Switzerland, Sweden actually surprised by a 1% move. Japan held tight and Hong Kong rose as well. So that is taking place around the world. One thing that other central banks struggle with to keep up with the United States is on what's called portfolio runoff, the shrinking of the balance sheet of the government. The United States hit their cap this month on September 1st of about $95 billion a month of runoff, 60 billion from treasuries, 35 from mortgage-backed securities. That's going to make it challenging for other central banks around the world to keep up, and a part of the reason why we're a little bit bearish on domestic developed equities, particularly those in those manufacturing sectors, industrial sectors that have a lot of cost domestically, internationally with revenues domestically.
And lastly, let's talk about commodities. You had touched on energy a little earlier on. Gold has been having a volatile year. How do you explain that?
Yeah, so I'll start on the energy complex. What's really happened as of late has been an underinvestment in the traditional energy infrastructure over moving into renewable and green tech. We think that movement's here and here to stay, and we see a lot of great opportunities on the climate change green tech side, but also in traditional energy and new type of technologies like liquefied natural gas, nuclear is coming back into vogue. Obviously, the tensions in overseas with the Ukraine, Russia, and Europe are putting them in a really challenging position. The price of a barrel of oil that we see here for about $85 US is close to 400 in natural gas prices when you convert the kilojoules. And so it's really stressing the UK and European consumer. On the gold side, it's a bit of a conundrum. You would think with high to runaway inflation combined with geopolitical turmoil, gold would be doing much better here. We've been light on the space, as you know, when the facts line up and you're not getting the outcome you deserve, maybe there's something else out there that we're not aware of. So we're waiting for a momentum change in the price of the commodity before we start to come back in a more meaningful way.